What's going on, guys? Welcome into today's episode. Today's guest is none other than Rod Khleif. He is a seasoned real estate investor specializing in multifamily, got one of the largest multifamily communities out there. He's an author. He's a coach. He is the host of one of the largest commercial real estate podcasts in the world. And Rod's got a really crazy story going back to losing $50 million, making it all back. And obviously a lot of learning lessons in there, especially being that he's been exposed to so many other real estate investors, the good, the bad, the ugly, and he's got a lot of insights to share. We talked about in today's episode the current headwinds facing the multifamily market and really just commercial real estate investors in general. What are some of the mistakes that many of those that are in hot water right now made so you can avoid making those yourself? How are people adapting and evolving in this current landscape? Where are they finding the opportunities? Where are they leaning into? And really, we dove into some of the creative strategies that you can navigate to drive more revenue, drive more value into your assets, how to underwrite better, how to protect your downside better, creative ways on how to navigate some of the high operating expenses, high interest rate environments, how to structure these deals. We dove into some of the opportunities, not only in multifamily, but senior housing, mobile home parks, some of the assets that Rod is paying attention to and that many of his community members are focused on, and just some overall advice from him, his outlook on what lies ahead. What are we going to see once interest rates start cutting? What does 2026 hold? I think you're going to get some great insights from Rod's perspective. So as always, if you enjoy the episode, don't forget to leave a review, subscribe to the podcast, and all of the links that we have from today's discussion are in the show notes on Rod's episode. Without further ado, let's dive into today's conversation. Long time no talk. Welcome back into the show, Mr. Rod Khleif.
Oh, thanks, brother. It's great to see you again. Let's have some fun today. See if we can add some value.
Yeah, I know, you're always kind of in the trenches on the front lines with your community, with the data, with, big whales, yourself. Last week chatted, it was a couple years ago, and obviously multifamily was slowly starting to hit some headwinds. And I think we were talking about, the mindset, navigating kind of, some turbulent times with interest rates. I think around the time we chatted, we're just starting to tick up. And obviously, it's been a challenging last couple years for, anybody that really got a little too rosy.
Honestly, anybody that bought in 21 and 22 is challenged right now. Even with good debt, we're major headwinds. So yeah, I'd love to drill down on some of that stuff because we're starting to see some of the impact of that. I was telling you before we started recording, we're starting to see some pretty crazy deals coming. For example, just found out about a 700 plus unit in Texas being offered for $10,000 a door. We're talking to Texas is, I don't know, an area in Texas you can find less than $100K a door. So, that's crazy. We have an asset in San Antonio, a 200 unit asset on a lake, beautiful, beautiful asset. The one next door sold for 40 something a few years ago. They're down to 28 right now, and we'll buy it if we can get it for 24. So, I mean, that's the kind of stuff we're starting to see it hit. A lot of these operators, the ones that didn't get adjustable rate debt, forget the ones that got adjustable rate debt, they're in deep, right now. They got the 3%, now they're at 8 or 9%, and myself included. I'm in a couple my ex-partner got me into. I'd like to strangle him over, and that are in trouble, but. And then, even the ones that have decent debt because expenses have gone through the freaking roof, taxes, insurance, and payroll. I mean, I teach this stuff and I teach 50% expense ratios. And candidly, it's hard to find anything less than 60% right now. And some are as high as 70% because all these expenses have gone through the roof. And so, it's and occupancy has dropped. Rents have flatlined in many of these markets and or declined. And we're seeing that in some of the markets that we're in. And so, the proverbial, the water's going out, we see who's naked right now. And so that's really what's happening. But with crisis comes opportunity. And I'm frankly excited because if you heard my story, I lost $50 million in 2008 and 9, got crushed. And I've had a lot of people on my show that killed it in 2009, 10, 11, 12, 13, 14. And, there's just because the opportunity was extraordinary. Well, I believe we're there again, definitely in the commercial real estate space, for sure, in multifamily, and even a little bit in some of the other asset classes. But
Yeah, and I know we'll kind of talk about some of the other asset classes. Maybe we could unpack a little bit on, for the people. Are you talking to a lot of people that are in challenging deals, whether they're LP,
Oh yeah.
or G?
Oh yeah, tons. And I mean, we're talking big, reputable operators.
Right.
Okay,
Yeah.
big guys have their own jets. I mean, these are the kind of operators that are in some challenging deals. And of course, a lot of the small newbies and stuff, that people that got started, but anybody that bought in 2021, 22, they're struggling on a lot of their deals. They overpaid because it was frothing, is a word to describe it. We saw this in 2006 with single family. It was frothing, and that's what happened. People thought that gravy train was going to last forever.
Yeah.
I only bought one asset in that time frame, screaming deal. But
Well, maybe you can
so
unpack that a little bit of like, what are you seeing and hearing that's happening right now, and how LPs and or GPs, how are they navigating it? The ones that are maybe navigating it the right way, the ones that are navigating it the wrong way. Like, what are you seeing?
Sure. Well, I will tell you, there are a lot of operators that just don't have their eye on the ball, and they're in trouble. There's a lot of deals trying to be sold right now for debt plus fees. So whatever the debt is, and these are deals that have tens or hundreds of millions of dollars over and above that. Well, tens of millions over and above that on an individual deal. A deal might be being sold for the debt that's 20 million that has 10 million in equity in it. Investors, LP investors. Now, unfortunately, the LPs can't do anything. There's nothing they can do really. Because very often they're accredited investors. They are alert. They are informed of the risk, and so there's not a lot an LP can do, but a GP needs to be all hands on deck right now. I mean, all over these things, on site as much as possible, talking to their management companies, holding their management companies accountable. A lot of these management companies, frankly, are not that great, even big ones. And I've discovered this because I had to step in to the asset management of 23 assets with my ex-partner that ran them into the ground. And what I discovered was, it didn't matter how good the management company was. Everything relied on the on-site staff. If there was a good on-site property manager, you could have a crappy management company and still do well. If you had a great management company, and a crappy on-site manager, the property would suffer. So I discovered this. I didn't realize how prevalent that was, and how relevant that was, because I just saw it for myself in the assets that I took over. And so, it's happening all over the place right now. Again, there's tons of operators that are in trouble. And there's a debt wall right now. Debt is coming due, and I mean,
talk about that a little bit. Like, what is, from your perspective, debt wall? What does that mean, and what is, in your opinion, coming around the corner?
So in the commercial real estate space, you can get a 30-year amortization, but you're going to have a term, and it's a balloon payment basically in 3, 5, 10 years. Now, a lot of these adjustable bridge loans that operators got are already due. And right now the catchphrase with lenders is extend and pretend. Okay, that's their catchphrase, because what they're doing is they're doing loan modifications, they're doing deferrals, they're trying to kick the can down the curb, hoping that the rates will come down enough to save these deals. But some of these deals are in really bad, and then we're starting to see foreclosures much more prevalent now. They're taking them back, and so it's happening right now, and you're going to start seeing deals going up for auction. You're going to see these lenders take these things over, and there's going to be opportunity, candidly. But it's sad because there's a lot of investor money that's going to be wiped out, already been wiped out. Again, I'm seeing it with very large, sophisticated operators that have had to walk away from deals.
What did they
it's
miss
very,
though, right? Like, because I've seen that too. A lot of my mastermind groups that I'm involved in, guys that, just look like they had the Midas touch. And honestly, like you said, long-standing operating track records of, being good fiduciaries, good stewards of capital,
right.
good
Well,
syndicators. What did they miss in this last cycle that
the, the,
that
the
that
biggest
got them
thing
in
was
this
the
trouble?
bridge debt. Yeah, the biggest thing was the adjustable rate debt. I mean, that was a deal killer for anybody that got into it. And see, what happened was Fannie Mae and Freddie Mac dropped their loan to values. Okay, so they dropped all the way down to 65, 70%, 60% even in some markets. And they were at 80%. Okay, so um, when you're doing a pro forma on a deal, the less money out of pocket, the less equity it's called that goes into a deal, over and above the debt, the better the returns are, right? So the less money in a deal, the better the returns. And so, operators would use the bridge debt to get the higher loan to value because they were able to get higher loan to value than Fannie and Freddie, which is conforming debt. Conforming meaning if they foreclose, they only take the property, they don't come after you personally. So operators would do bridge debt, and there was actually non-recourse. That's called non-recourse. There was non-recourse in the bridge lenders as well. But the point being, Fannie and Freddie are very, very conservative. They've been through these cycles before. They saw the writing on the wall, where these bridge lenders came out of the woodwork and loan money at higher loan to values and even loan to cost sometimes, but the debt was all adjustable and short term. And so, once the rates went up, I don't know how many times over a short period of time, and now this freaking moron at the Reserve won't lower them. He's at odds with Trump, Powell, I'm talking about here, and the whole world has dropped interest rates except for us because it's political, I'm sure. But anyway, we won't go down that rabbit hole. But the bottom line is, so that was a big thing, and then again, the operations is huge, and the costs that have gone through the freaking roof for these assets is, payroll. I mean, we're paying exponentially more for on-site staff these days than we were before. It's inflation. Inflation's causing the payroll to go up. Taxes have gone up. In some markets, insurance is insane. Don't get me started on Florida. I live in a compound here in Florida. I had $1 million settlement approximately with my insurance company here. We've had assets in Texas that have been hammered, although we're getting drops there. Thank God. We're seeing it starting to come down now. But, that's just hammered the net operating income on these deals. And so, if you've got an operator, even a sophisticated operator, that's not keeping an eye on the ball and really paying attention to occupancy and costs and turnover and renewals and all of these things that we check on a weekly basis, it doesn't take long to get in trouble. So, and again, I've suffered myself. We've got a deal right now, unfortunately, that we had to switch out the management company on a couple of assets, and it's just a massive pain. We're in the midst of it right now.
Mm-hmm.
And so, these are some of the things that have popped up that have really hurt some of these operators.
Okay. Do you think that some of these costs are, the OpEx increases are transitory, or are these going to kind of be sticky and people need to readjust their expectations around modeling?
Yes and yes. I think that people need to readjust their expectations, and and these historical deals are not going to have the returns that were promised by any stretch of the imagination. That said, I think rents will ultimately go up to offset some of these costs. I think it's inevitable, and that's the beautiful thing about real estate is commercial real estate. That is, the value is based on a multiple of the net income. Any increase to that net income is an exponential increase to the value. I'll give you an example. We've got a 296 unit asset in San Antonio, a mile away from the other one I was just talking about, where we painted numbers on the parking spaces and we allowed the tenants to say, hey, here, you can reserve your parking space right in front of your unit if you want. It's $25 a month, first come, first serve. We had 100 people take it. And at that time, that asset was at about a 4 cap. So here's the math on that. And people are like, oh, you're an idiot. You can't do math. Well, here's the math so you understand it. Okay. What you do is you take that $25 a month and you annualize it. So in this case, it was 2,500. 100 people took it times 12 is 30,000. You divide that by a 4% capitalization rate, which is what it was at the time. It's not that now, but back then it was. That was a $750,000 instant increase in value for some paint on the parking lot. We didn't even pay for the paint. We had a towing company pay for it to have the towing contract. So, that's what's possible in our business. And it's called value add. You go in and you improve the units. You do make capital expenditure projects. We just did that on that 200 unit. We spent about almost $4 million there to improve that property. The one on the lake I was talking about a minute ago, and the one a mile away from this one. And and we like I say, we spent almost $4 million in capital expenditures and just really juiced it up. It's in the 90% occupied now. It's just a beautiful asset, but and the value has skyrocketed because we've increased the rents. And see, that's the thing about commercial real estate. You can buy a property today and fix the debt, but with inflation, we're still going to have inflation, and inflation impacts everything, including rents. And so your rents go up, your value goes up. So it's a beautiful thing about commercial real estate. But yeah,
what have been, because I know you guys are really creative and have seen a lot of different case studies and uses for how to either lower OpEx or how to drive additional ancillary revenue, opportunities on site. What are some of the ones that you have seen pay real dividend that have, like you said, right, drop more
sure,
to
you
the
mean
NOI?
like income? Yeah, income like I just described. Well,
Yep.
of course, parking is a big one. We haven't done it at that 200 unit yet. We're about to. We had to repave it, whatnot. We're about to charge for the parking there. But another one is a cable contract. That could be very lucrative, where you bring in a global cable contract at a price less than the people can get it themselves, and then you sell it to them, and you make a piece of that, which can be very profitable. Goes right to the bottom line. Oh boy, tech packages can get your rents up. You can participate in insurance for the tenant insurance, and get some spiffs for that when you participate in the tenant insurance program. Then which you should insist that tenants get, because when there's a fire, they could literally lose everything. We had a fire in one of my Nashville assets. I'm sorry, my only Nashville asset. We had a fire, 20 units burned to the ground, and so all those people lost all their, now we set up big drives, and we had garages filled with furniture and all sorts of things to help these people out, and clothing and everything. But, many of them didn't have insurance because we hadn't owned it that long. And so insurance is another way to drive revenue. There's so many things you can storage on an asset if you've got space for it. But certainly the most common is just to improve the units, improve the exterior, and start creeping the rents up. Once you're in the 90 to 95% occupied, you can start looking at increasing rents.
Yep.
And so yeah.
What have been some of the, being that you've had to take back some assets from management, what have been some of the red flags around kind of those managers, and what have been some of the things that you guys have really focused on to create more efficiencies, to compress OpEx?
Yeah.
What are some of the things that you guys are focusing on?
Compressing OpEx is a challenge. It just is.
A lot of it is
I mean,
uncontrollable, right? I mean, it's
Well, it
third-party
is.
vendors and
Even
things out of
employees.
your
I mean,
control.
yeah, I mean, maintenance guys are, they're making $30, $40 an hour now, when, they were in 20 before, so in fact, 40 to 50 even, actually, thinking about it here some more. But, that which goes right to the bottom line. I mean, it impacts you.
Yeah.
But, as far as efficiencies, I tell you, that's been a big challenge. Insurance, a big one. If you can improve the, put that out for bid, put your vendors out for bid. Multiple bids on everything is one for sure. It's harder to minimize expenses than it is to drive rents. But sure, your trash contract, put that out. I mean, that can be. You can save money there. Any of your vendor contracts should be put out for bid every year. We have something in the business called vendor creep, where it just seems like that price goes up every year. Yeah, no, not on my assets. It needs to go down every year, and so we put it out for bid. But Yeah, I mean, you can be creative to draw more income, buy washer dryer units and rent those out. We're doing that, one of the assets.
Yeah, I mean, there's a lot of different ways, right? That it, like
Right.
you said, depending on what the asset, what the market allows, it's all about getting creative and identifying some of those areas that maybe your asset doesn't have or could allow for. What are some of the things that, as an analyzer, as an underwriter, right, focusing on making your money on the buy, realizing it over time as you execute on the business plan? What are some of the, I have my assumptions that I believe a lot of people, missed on, hence why we're in some of the, situations that we're hearing in the market today with people in trouble. But what would you say are some of the rules of thumb when it comes to analysis and underwriting that maybe, have changed, or just that you're looking at, like, how should people be underwriting assets today?
Well, I've always been super conservative. I lost $50 million in 2008 and nine. Hit me once, shame on you. Hit me twice, it's Rod's own fault. Okay, and so, so I'm very conservative. So we haven't changed that much. Minimum 6 months of expenses is operating reserve. Hands down. Sometimes as much as $1 million sitting there just in case what hits the fan, which it
Hmm.
has. So
Yep.
that money's been a godsend in some cases. Um, Super conservative underwriting. You've got to try to calculate your exit cap rate because that's going to drive what you sell it for or refinance it for, and you've got to have some reality there. And that's been next to impossible with these rates, all over the place, and no quarter on those rates yet. And so that's very challenging, but you want to be conservative with that, conservative with your rent projections, because you see rent projections where somebody will say, "Oh, it's going to go up 5% a year for 5 years." Well, not right now. It's not. First year for us is zero, no increase. Second year maybe 2 or 3%, and it goes from there. And a very well known figure in the space, very dynamic figure that's got his own jet and helicopter, and I won't bring the name up, and many will know who that is. I saw one of his pro formas, and he was performing a 10% increase every year for 5 years. I mean, come on.
Well, I know
So,
a lot of people
you
that are
got,
in his deals and haven't
yeah.
received a distribution in quite some
Yeah.
time.
Okay. So you know what I'm talking about. Yeah. So you've got to be realistic, and conservative. Conservative is the word of the day. Now I've been conservative, but that is the word of the day. And um, yeah, lost my train of thought there for a second. But yeah, I'm sorry, I
Yeah,
forgot the
I mean, I
question.
think, question more so around just like how are you analyzing, the key assumptions, right? I always say is, overestimate what costs are going to be, underestimate, what you can exit it for,
Right. Well,
overestimate the.
you'll see a pro forma where they show the rent's going up, but they don't show the expenses going up.
Mhm.
Hello, I mean everything goes up. So
Yeah.
it better, and it's candidly very similar. If you got a 3% rent bump, you better have a 3% expense bump. So all of those things that you see some crazy stuff. And again, and I have about, I don't know, 17, 1,800 coaching students around the country that now own 265,000 units that we know of. I think it's probably closer to 280 or more thousand units under my tutelage, something I'm very proud of. And that's just multifamily. They're called my warriors, and they're doing every asset class. I mean, it's crazy. I just interviewed one just literally right here about an hour ago that's in self-storage and industrial flex space. And we got a ton of that: senior housing, student housing, mobile home parks. All the asset classes are represented in that group. So I get to see a lot of different things. I get to see challenges. I get to see opportunities, and I get to see, really what's happening in a pretty wide swath of deals in the country. And it's been really illuminating to see what's happening. And I will tell you something I'm very proud of. In that warrior community with all those doors, only one deal's been lost. Knock on wood, knock on wood. Only one deal's been lost. So very, very proud of that as well. Because I hammer conservative nature into all of them. But
Well, what are your
yeah.
thoughts? You're talking about opportunity.
Mhm.
where are you seeing opportunity? Where are you starting to, maybe lean into, transact
Yep.
in outside of,
Yeah.
obviously, I know multifamily is kind of one of your core verticals and pillars
Oh yeah. Well,
commercial real estate.
that's what I started with. I mean that's what I started my podcast with was multifamily because see when I lost everything in 2008 and 9 I had 800 houses and I had several apartment complexes along the Gulf Coast of Florida. Here it was the houses that pulled me down and I was only at a 30% loan to value and I still crashed and burned. But
Wow.
my apartments did just fine. My apartments, they pulled back about 11%. They would have survived if I hadn't cross collateralized them with packages of houses. So, I started my podcast to say, hey, if you're going to buy and hold freaking real estate, do multifamily, don't do single family. Ask me how I know. We give away T-shirts at my boot camps that say hashtag ask me how I know because I've made every mistake in the book. I'm like, don't do that. Ask me how I know. But anyway, um, so I started the podcast for multifamily, but I will tell you, I've been a huge advocate for senior housing. I've got one deal closing next week in Pittsburgh, of all places. It just happens to be a great submarket for that right now. But I'm really big on senior housing. There's 10,000 people turning a day turning 65 in this country. I'm one of them. I just turned 65 in January, and so there's just an incredible shortage of beds for seniors, and it's call it a silver tsunami. It's going to be a very uh, dynamic asset class for decades. Okay, I mean that if you look at the baby boomer population, they've impacted everything from diapers when they were being born to suburbia to in the cities to now it's going to be senior housing, and so that's a tidal wave that's coming. That's kind of exciting. So I'm actually going to a big conference in Austin, Texas, called the NIC conference. Don't ask me what it stands for. I just know it's senior housing. But anyway, it's all senior housing. But yeah, so I'm excited about that asset class. I'm excited also about affordable housing in whatever manner that looks like.
Mhm.
And so mobile home park investing, something I have spent a lot of time studying. I haven't pulled the trigger on. My brother owned a few parks. A good friend of mine owns a bunch of parks. But I think that's a very exciting business as well that still has opportunity in it. I have students that own quite a few mobile home parks and a ton of senior housing. My warriors, my coaching students. And by the way, can I do a little plug?
Please.
If you're interested in applying to my warrior coaching program, like I said, it's just extraordinary what they've accomplished. Text the word crush to 72345. Crush CRUSH to 72345. That's how you apply. But anyway, yeah. So like I say, I'm blessed to be able to see a lot of these different asset classes happening. They've done hotel conversions to multifamily very lucratively, by the way. Like industrial flex space, like I said, mixed use, ground up development, just a ton of stuff happening in that group. It's extraordinary to watch.
What are you seeing in
Um,
the debt markets right now? What are you seeing with liquidity and dry powder coming into the space or not? Like what's your overall kind of macro, micro economic pulse right now?
th- there's a lot of ostrich stuff happening right now where you can see their butts above the ground and their heads are in the sand in the lending space, and that's what happens anytime things get tough. You see it with these bankers. I saw it in 2008 and 9. It was like a light switch. You couldn't have borrowed money to save your life, and so they're tightening up for sure. It's much more challenging. Debt is much, and so is equity. I mean, a lot of investors, that invested in some of these deals that they either lost their money or they're not seeing the returns they were promised or skittish. And then of course you see the economic news and don't get me started on the crap that comes out in the media, but a lot of investors are scared. And so it's harder to raise money for sure. And I raised money for that senior housing thing in literally 3 days because I mean, it's kind of a
Why do
common
you think
sense
you were
thing.
able to do it so quickly versus the headwinds with equity in the market right now?
Well, because it's kind of a no-brainer. I mean, if you put on your logical cap, you can see that senior housing is it's kind of hard not to see what's coming and what's happening with that and get comfort with the fact that there's a huge need. And there is. I mean, it's not hyperbole. It's real. There's a
Mhm.
huge need in the space. And so, it was a cakewalk to raise. And it wasn't a big raise. It was only a few $1 million, but still, you know, um I think that's going to be easier for us, and we're gearing up to do that in a big way. I'd like to try to buy 10 assets in the next 12 months. So, I'm putting a team together. I've got ads in right now. We're putting all the pieces together in that right now because I really love the space. I got my assisted living administrator's license in 2007 because because I love the elderly. I love kids and I love the elderly. And I was gonna get into it then. And then, 08 happened and, everything blew up and I kind of backed off on it. But, I was threatening to do it back then. And now I'm finally circling back to it. So, yeah.
Very cool. And so, from your perspective, obviously, we talked a little bit about Powell and, you know, America always being late to the party with, reduction of rates. You think that at least right now, I think we got like a 93, 94% chance of a rate cut in
Yeah,
September. Not
I
that
think I think so too. The problem is, what's it going to be?
I was going to say
Is he
25
going
basis points
is he going to do
provide a lot of
25
relief.
basis points? Well, it's not going to do anything. Honestly, it's not going to help anybody. And so, it might help attitude, but it's not going to move the needle on any of these assets that are in trouble. So, you know,
What do we
I
need
don't
to
know how many.
see for some of the distress to get the help they need, or is it already kind of
But
too late and it's going to flush through the system?
I think for a lot of them it's too late for them, to get because see here's the thing these assets that have a debt wall that have debt due and that they're doing loan mods on, they're doing deferrals on, they have two options. They either have to sell or they have to refinance. Neither one of them is happening right now. Sales are down 90%. Refinancing, they have to meet debt service coverage requirements. In the commercial space, the banks, lenders look at the property's ability to service the debt. They don't care how much money you make. They need to make sure that that property can cover the debt. And typically, the most common metric there is about a 1.25%. So to give an example for those of you that haven't heard this before, if the property's net income is $125,000, this is an annual calculation. Say it's $125,000 for the year, and the debt is $100,000. That's a 1.25% debt service. 125 in income, 100 in debt. That's a 1.25, which is pretty much the minimum that most lenders want to see.
Yep.
But you can, with the interest rates, you can't get there. And so, we're seeing these deals I was telling you about that are being sold for debt plus fees. They don't even pencil out. They don't make sense because the interest rates are too high.
Yep.
And so, like that deal I was telling you about right next door to the one we have, it sold for $40 million, and it doesn't make sense for us at 28. It's got to come down to 24 for it to make sense. And everything relies on cash flow. Don't get excited about being able to buy a deal for millions less than it's sold for. That's irrelevant. It's all based on the property's ability to service that debt and cash flow. Cash flow is everything. So keep that in mind. In fact, in the book that I give away, I'll put a plug in for that. I've got it behind me here. But anyway, it's called How to Create Lifetime Cash Flow with Multifamily Properties. The subtitle is The New Rules of Real Estate Investing. The new rules being everything relies on cash flow. Cash flow is everything. Forget how much you paid for it and how much you could have got, how much they sold it for, whatever. That's irrelevant. So
Yeah, you can't eat your net worth, or your balance sheet doesn't feed your family, right? Like you need the cash flow.
It's all about cash
to,
flow.
Yeah, the cash flow is the moat for the asset.
Yeah.
So,
By the way, let me put a plug in for that. If you want the book, I give it away for free. You can pay the shipping. It's like $6, literally 6 or 7 maybe. Go to rodslinks.com. Rods plural, linksplural.com. There's a bunch of free books there, and they're best in class books. I mean, some of the books there are better than you can buy about different pieces in multifamily real estate investing. So again, rodslinks.com. And my best-selling book is the number one bestseller in 3 categories. Is if you pay the shipping, you get the physical copy. The other books you get a PDF, but you can get the actual physical copy of that one. And there's a bunch of free resources there. And also my goal setting workshop is there. So if you haven't done your goals, you can spend an hour with me. There's a guide you can download. I'm not going to try to sell you anything. People spend more time planning a freaking birthday party than they do designing their lives. That's designing your life, doing your goals. So if you haven't done them, go to Rod's Links and do the goal setting. Have your spouse do it. If you got a kid that's over 10 years old, have them do it. Have them design their lives. It's incredibly powerful.
where are you finding the opportunities right now? Where should people be looking? Where are you seeing your students? Where are you seeing your community, yourself? Where are you guys finding deals right now?
Everywhere. I mean, you just have to beat the bushes. And obviously brokers is the easiest. Brokers are much easier to talk to than they were 3 years ago. They were the belle of the ball. You could hardly get them on the phone. Now, I can't tell you how many emails I get a day on deals these days. It's insanity compared to what it used to be. And so, they're much more pliable and flexible and communicative than they were in the past. But so brokers, but I teach, I do boot camps, and I teach people how to, lots of other ways to find deals and some ninja tricks for finding deals. I'll give you another one. If you've got a market, you want to buy in, find a residential agent or broker in that market that has access to the MLS system, and tell them to put an alert in there if a multifamily or some other asset class you're interested in pops up. Because here's the thing, if somebody has a 10, 20, or 30 unit building that they built or they've owned for a long time, and then they buy a house through a residential agent or broker, when they go to list their building, they're going to list it with that residential agent or broker who hasn't got a freaking clue what to do with it. And you get some phenomenal deals that are mispriced because the agent didn't know what they were doing. So, that's a little ninja trick for finding deals, but there's so many ways. Again, I teach them on my boot camp. I'm not going to sit here and plug after plug after plug, but if you go to Rod's links, my site's there, you can check it out there too, my boot camps. I do a virtual event every couple of months or so.
Now, talk about some of the different creative deal structures that you've seen working in a challenging market like this, and maybe that will continue to work going into.
We're already seeing a lot of seller financing. That's come out of the woodwork, and this is very recent. We've seen deals where the seller stays in the deal for part of the equity. Okay, they contribute part of the deal for the equity, meaning the down payment, to minimize the amount of money that someone has to raise. So those two things are very common these days. Or a seller will finance behind primary debt in a deal to, again, minimize the equity that needs to be raised, because that seems to be the biggest hurdle, is the equity raising right now. And
Yeah,
so,
I just did that on a mobile home park. Got a 75% LTV on a off-market mobile home park from a community bank. I got the seller to carry back the remaining 25%. I think I wired less than $9,000 total on the entire
how
mobile
many
home park.
spaces? How many
It
spaces?
was only 15. It was a small one.
Okay.
Yep.
Still awesome, brother. Awesome.
Yeah. It was.
Although you're a glutton for punishment, is that in your backyard or where is it? Who's going to manage that
No,
for you?
it's one of my partners on another hotel deal that I had. We sold that one. We needed some debt replacement on our 1031 exchange. He owns 3 other mobile home parks in this area of Wyoming.
Oh,
So
perfect.
they've already got,
Perfect.
a couple hundred pads out there. So this was just
Okay.
kind of bolt on to their existing management company.
So whoever a manager, another asset can manage those 15, because that's the hassle. In that space, in the mobile home park space, you don't want to do less than 50 or 60, because you need an on-site person that
Need
you
some
can,
scale.
pay a little bit of money, and
Yep.
otherwise you're dealing with a tough demographic, as it
Yes.
were. I mean, not to say that, anything against that, because people need a place to live, but yeah. Anyway,
Yeah, it's no
got it.
different, right? Like you said, whether it's mobile home parks, I mean, even with my hotels, the smaller ones are always more challenging, right? You need the top
Yeah,
line revenue to
you need the
have the
scale.
level of scale in order to have a staff, unless you are planning on being the mom and pop operator or the boots in the ground business operator every single day. If you want real leverage and freedom, you got to find some scale with some of these assets, right? So there's some sweet spots to those thresholds of price point, what kind of top line, what kind of OpEx, and what's left over, right? Obviously, you need to be able to service your debt and still have enough to, generate the yield you're looking for. Or if not, you're going to be a slave in the business, which is unfortunately what I see from a lot of real estate investors that don't understand that.
Yeah, yeah, for sure.
So, as we kind of wrap up, what's your overall kind of final message right now to people that are out there trying to be proactive, trying to sharpen their skills, looking for
Existing
opportunity?
existing operators or new?
Maybe
Or
both.
both?
Yeah.
Okay. Well, if you're existing and you have some assets, by God, you better be all hands on deck right now. I mean, you better be communicating with your lender if you've got challenges, over communicating with your lender if you've got challenges. On site as much as possible. all over the management company, exhaustively reviewing your KPIs, your renewals, how they're doing, your delinquencies, your deposits, your how long maintenance tickets are out, safety, security, all these things you need to be all over on a weekly basis minimum. For brand new, there is no better freaking time to get in this business than right now, because incredible opportunities upon us. I just mentioned a couple of deals that I'm personally interested in, and so you're going to see a lot more of that. And this is when the bigger money is made, when there's crisis and there's discounted pricing, because it's coming. They have to, and a lot of these deals are going to get taken back by lenders. Lenders are not in the management business. They need to unload these things and get them off their balance sheet absolutely as fast as they can. If it's banks that own them, they'll very often finance them to get rid of them. So there's just opportunities coming. Get up to speed as fast as you can. If you're interested in multifamily, get your butt to one of my boot camps. Just again, go to Rod's links and the information's there. But that's the thing I would tell you. Don't wait, because I'm going to tell you, there's going to be opportunity buying businesses. There's these 65. These 10,000 people a day turning 65 that want to slow down their lives. They have businesses they want to sell, but don't dabble. Whatever it is you want to get into, go study it, learn it. If it's buying businesses, if it's buying mobile home parks, if it's buying multifamily, whatever it is, go learn it so you can capitalize on it. Because I'm telling you, it could be the greatest transfer of wealth we see in our lifetimes. We could still have a recession. Debt just hit $37 trillion. I mean, if you want to be freaked out, take a look online to see the difference graphically between $1 million, $1 billion, and $1 trillion. It will blow your mind how much money $1 trillion really is. And I mean, we can barely cover the interest rates, the interest on that debt right now. It's about what we collect with the IRS. So it's go check out a debt clock and see how that thing's accelerating. Some point somebody's got to pay the piper. So I love Trump's tariffs ideas. I hope that helps with it. I don't know if it's too little, too late. We'll see. But we could be heading into some real pain. We'll see. I hope not, because it's I've been through it and it's no fun. But again, regardless, there's opportunity. There's definitely opportunity in my space. I think there's opportunity in other areas as well. These owners that need to sell their businesses very often will finance them. So if there was two of me, one would definitely be buying businesses as well, by the way. But anyway, so that's my advice.
It is interesting, right? I mean, stock market, all-time highs, crypto market, all-time highs, housing, we'll call it, equity, all-time highs. You got
equity, yeah.
There's so many things that feel like potentially could be in a bubble, or maybe we're just in different times where, I heard somebody say recently, the age of the internet was talked about in billions. The age of AI is talked about in trillions. So, it's hard to compare sometimes apples to apples when there's different variables, especially exponentially transformative variables like AI, like some of the things that we're seeing with technology. But it does make you a little concerned when you really zoom out and look at how big some of these potential issues and dominoes, if they fall over, could create a chain effect.
I tell you, I was listening to Joe Rogan. I get excited because I host the largest commercial real estate podcast really in the world now. And I've had I don't know, probably pushing 30 million downloads. And Joe Rogan gets that, a week probably. Anyway, so I was listening to Joe Rogan and he was interviewing this AI expert. And it was kind of scary, I'll be honest. Like 20 to 30% chance that it ends humanity. Okay. Not in decades, in years. Okay. This is, we could have a whole nother conversation about that, but it's extraordinary what it does. My God, it's just crazy when you plug stuff in and see what it spits out in split second.
Mm-hmm.
And we're using it. I just did a video. Have you seen those woolly Bigfoot's talking and all that.
Yeah.
So they just did one for me where it goes in between me and the Bigfoot guy, and I was just really cool some of the stuff that it'll do these days. But yeah, I'll tell you, if you're listening, still listening, suffering through my dialogue here, learn AI, okay? If you don't, you're going to get left behind. You need to be if I was in my 20s, I'd be all over AI, period. I'd be on it, because incredible money's going to be made there. So
Yeah, we're leveraging some AI agents that we're beta testing inside of the business for deal analysis, for lease analysis, for our database management, investor relations. I mean, you can essentially create full-time employees now that have autonomy, and the efficiencies are honestly way better than most human beings. It's insane what you can do, and I continue to believe that that is going to be the way of the future and the age of the future, with many different aspects of industry, especially in real estate, that are a little bit inefficient, archaic, and can be enhanced with
i.e.
AI.
opportunity. I.e. opportunity. Yeah.
100%. 100%. Well, Rod, as always, brother, it's great catching up with you. Always
Good
love
to see you,
getting
my
a
friend.
pulse from your perspective on what's going on in the real estate market. For those that want to check out Rod, we'll have all the links that he mentioned in the show, down in the show description. Thanks for joining us today.
It's good to see you, brother. Thank you.
Well, that wraps up today's episode. Thank you so much for tuning in. As always, you guys know this show would not be what it is without you, the amazing listener, the support, sharing this out with other people who can gain value from it, taking 60 seconds to leave a review. If you haven't done so already, those things mean the world to us and ultimately help us spread this message out to as many people as we possibly can to help them on their wealth building journey. If you have any particular links or resources that you're trying to track down that were mentioned in this interview, be sure to check out this episode at MillionaireMindcast.com, where you can find access to all that information. And of course, if you haven't checked out the Wise Investor Vault yet, be sure to head over to wiseinvestorvault.com to check out all the tools, all the resources, the checklists, the spreadsheets, the trackers, all kinds of amazing things that can help you on your wealth building journey at the wiseinvestorvault.com. If you haven't connected with me on social media yet, I'm consistently putting out more content, stories, value to help you on your wealth building journey. And one of the best and most exciting things for me on a weekly basis is getting to connect with you guys. Getting your DMs, hearing what things impacted you, what you need help with is a big way that we continue to drive the content for this show. So if we're not connected and following each other on Instagram, on social media at official Matty A, give me a like and a follow. Would love to connect with you there. And of course, don't forget to get on my deals list. If you're an accredited investor, you want to look at more deal flow. You want to see what deals I have access to, what deals I'm raising capital for. This is an exclusive list that I only put out to my accredited investor list, my Millionaire Mindcast family. So text the word deals to 844-447-1555. And with that being said, thank you again so much for supporting the show. Until next week's episode, keep investing in yourself and your wealth on your march to $1 million and beyond. Cheers.